We got a lot to cover today. So first of all, I just wanted to welcome everybody to this Lunch and Learn. We're going to be talking about early stage seed funding via equity mechanisms. And a couple of things just to share with you. First of all, I want to let everyone know that this event is being recorded. So, and what I will do is send everyone a link to the recording at the end of the event. The way we're going to run the Lunch and Learn, we'll spend about 45 minutes talking to our great panelists here on the call. And then we'll go ahead and open it up for questions. And so what I'll be doing is monitoring the questions. If you could please just put them in the chat room, then I'll capture those questions as appropriate. I might interrupt and ask the question, but really we're going to set aside 15 or 20 minutes at the end in order to make sure all your questions are being answered. And we have quite a few people that have signed up for this event. So if for some reason we don't get to your particular question, go ahead. I put my email up here. It's just laura@venturecatalyst.biz. And I'd be happy to grab your questions and then send it to the appropriate panelist. And for those of you that don't know me, I am the venture catalyst for Washington County. So I work one-on-one with entrepreneurs throughout Washington County and a few entrepreneurs outside of that region. I'll assess your business plans, help coach you on your business to get you on a growth trajectory. And I'm also a connector. So if I'm not the right person in terms of your specific needs, then I'll make sure I'll connect you to someone within the entrepreneurial ecosystem to get the support that you need. So before we get started, I would just like to thank our sponsor for this event, Buchalter Ader Wynn. And Ernie is the shareholder of Buchalter Ader Wynn, and he's going to serve as the moderator. And I also want to make sure that I thank everyone that is supporting me in this particular role: Washington County, City of Hillsborough Economic Development, as well as Forest Grove Economic Development, Oregon Community Foundation, and also TIE Oregon. So without further ado, I'm going to turn it over to Ernie, and he'll have everyone in our esteemed panel introduce themselves. So Ernie, take it away.
Good afternoon. As Laura said, I'm Ernie Boetsma. I'm a shareholder with Buchalter Ader Wynn. And just a brief background about our firm. We're a law firm that's based on the West Coast in these 9 cities. And I and many of our team have been working with lots of entrepreneurs and investors over the last 25 years. We do everything from formation, funding to exits. So now I'll turn it over to our great panel. We have a very esteemed panel today. We have Juan Barraza, Ben Nahir, Himalaya Rao. Did I say that right, Himalaya? And so I'm going to let them each introduce themselves. They all work in the venture capital space and investment space and have quite a wide variety of experiences. And maybe each of you could tell us a little bit about yourself first. Why don't we start with Juan, just because you're closest to me on the screen.
Thank you. Good morning, everybody. Good afternoon, depends where you are and what time zone. My name is Juan Barraza. I wear a lot of hats in the community. My newest endeavor is Vamos Ventures. I'm a scout for Vamos Ventures, a new fund focused on investing in Hispanic, Latinx, and entrepreneurs across the country. Vamos has established a scout program. 12 of us are roaming the country in our communities looking for those high-value entrepreneurs. With the Hispanic community having a 1.7 trillion buying power, I'm sure we will find some of those here in Oregon, across the nation. So glad to be here.
Thank you, Juan. Ben, why don't you step up next? Tell us a little bit about what you've been doing with Elevate the last several years.
So first off, very happy to be here also. I work with both Ty and Elevate, but for Elevate, I am the venture principal, which means I manage all of the front end deal flow, sourcing, early stage vetting, and I help with diligence. I help with decision making when it comes to investments. And then I also do portfolio management. So I get directly involved with our companies and our founders once we've made investments and help them grow their companies, help guide them through strategic challenges, as well as getting them to the next stage for investing. And I think what's really fun about working at Elevate is our mission of supporting underserved entrepreneurs. And so we started that when we founded the fund 5 years ago, and we've continued to grow that and continue to develop that as we launched Fund 2. And as part of that, we've grown out of the Pacific Northwest ecosystem. And so we're making connections with other like-minded funds, not only locally, like what Juan and Himalaya are doing, but also nationally with organizations like Astia Ventures and Jumpstart Health and Impact Seat and a lot of these others that are, we're starting to create this much more holistic network to support these kinds of founders.
Thank you, Ben. Himalaya, why don't you tell us a little bit about yourself?
Okay, thank you so much, Ernie. So hi, everyone. My name is Himalaya. I have 2 different roles that I play. One is with Portland Seed Fund, and so I help in the context of what Ben just said on the front end and being able to source deal flow as well as do due diligence on that. But then I also am the managing director of Black Founders Matter, which is a $10 million seed stage fund. And I do both the front and back end work of that, as Ben alluded to, because that is a fund that me and Marcel Michel operate and run. And so our fund thesis with that is that we connect with Black-led ventures across the United States. So just as Ben mentioned, we are also connecting with partners and industry-specific lead firms across the United States in various verticals, like with Energy Foundry and Sofinnova. And so that's kind of what we do, and I'm excited to continue and talk a little bit more about that later.
Great, thank you, Himalaya. Well, why don't we stay on that topic of fund thesis? So maybe each of you, your individual funds, kind of comment the investment differently and who you're serving. So maybe let's talk a little more about the fund thesis. Juan, maybe a little bit about your fund.
I'm muting myself. No, thank you. So we're industry agnostic, right? We definitely would look all types of deals coming from the entrepreneurs that come to Vamos. But with that said, we have a specific interest in 4 sectors, 5: financial services, health and wellness, future work and education, and consumer packaged goods, food tech. And we are developing that sector in particular. Is very appealing to us in the sense that it's very low amount of funding that goes towards food tech, and we'll be looking and fund entrepreneurs. They are exploring the direct-to-consumer play, food and beverage, consumer packaged goods. So those are the types of investment that we do. We're looking to start in the seed round. Initial checks is about $100,000 for seed round. We can lead and follow on investment. So we can go up to $500,000 in investment. Happy to partner up with other funds as a co-lead or lead a Series A round.
Great. Thank you, Juan. Ben, why don't you tell us a little more about Elevate's thesis and kind of your approach to investments?
So I spoiled the surprise a little bit by talking about supporting underserved entrepreneurs, but really that is the core of who we are. And so that's the mission of Elevate. The thesis is much more focused on technology, and we have an allocation for healthcare. And so when we see an overlap between the two, that's something that we get excited about in particular. But within technology, which is obviously a very broad space, we are relatively agnostic. So we'll look across different types of businesses and different types of industries. We're mostly interested in opportunities that have a large market potential. It's something that is truly going to be, I hate the term disruptive because I think that gets overused, but something that is going to really solve a problem for a particular type of customer, and something that can scale to solve to go beyond those types of customers. So that's what we're looking for. And then we want to see a founding team that is diverse and that represents those values. So it has to have someone that is a minority, a woman, LGBTQ, a veteran in a meaningful founder role. So not just a small percentage, but someone who's actually got voting power, who is actually making decisions for the company and is strategically involved in the direction that the company is going. And so our target check size is about 250,000 to $1 million. We typically come in at the seed stage, although we will do some smaller investments in pre-seed when we are particularly excited about usually the founders and the team more than the business itself. And our expectation is that we'll probably lead about half the deals we do. We'll follow on about the other half. And then we do expect to support companies through Series A and then help them find those next investors for Series B and beyond.
Thank you, Ben. Himalaya, you touched on it already, but I'll come back to you. Maybe you can kind of wrap up this topic and tell us a little more about your approach, your fund.
Absolutely. So the vision of Black Founders Matter at the inception is that we believe that innovation is fueled by differently lived experiences, and that those different experiences bring different perspectives and solutions to the table. And so that's why we heavily prioritize differences in our innovation sourcing. And so we, as the name suggests, are focused on Black founders as they have drastically differently lived experiences. And so, as also Ben mentioned, we are looking for Black founders, one, that have a meaningful equity stake in the company, but then two, are also the driving force in the strategy and setting the vision for the venture. In terms of what our average check size is, we range from 100 to 250. We're in between the seed and Series A, mostly on the Series seed. And then in terms of our industry focus, we are industry agnostic. What our fund strategy is actually to be a connector fund. So actually, you saw like a huge emergence by corporations, family offices, and larger funds to diversify their deal flow in 2020, but they don't always have access to particularly high growth Black startups. And so that's what we do. We know how to source them, we know how to screen them, and then we partner with industry-specific lead firms to be able to then help lead and close the fund, because what we found is that industry-specific firms not only provide the capital, but also the resources to be able to understand the competitors, the different players, as well as Ben was mentioning, the Series B and beyond lead firms in that specific industry. So that's what we do. We focus on industry agnostic, and then we partner with industry specific.
Thank you, Himalaya. Well, let's switch gears a little bit and let's talk about the process. So maybe each of you could tell us a little bit more about, how does the audience, they probably all have companies, they're looking to find funding. How do they meet you? When is a good time to start talking to you? Is it good to do it early in the process? And again, what is that process like, and what is your approach? And maybe we'll just kind of go around again. Juan, do you want to start with that question?
Yeah, we understand that the traditional role of the venture funds has been like a come to me, and we have a website and fill an application, and then we'll reach out or we'll tell you when we're ready for you. With the Scout program, we actually intentionally, the fund is looking for folks on the ground that are embedded in the community. They would look for those entrepreneurs and go talk to them, right? Getting to know them. From that point, any stage, as even you're not ready for investment, want to talk to you and being able to share the back end, what is that we're looking for, and guide you through the process. Not everybody's ready to be part of a funding round, and we're going to be able to give you that transparency to know the process and being able to understand how you can get ready for funding. And if you're not, we will let you know what are the elements they're missing to be able to guide you through that. To what Himalaya and Ben alluded, we're definitely looking for that heavy led team by Latinx entrepreneurs. They're part of the team. And not necessarily they need to have a friends and family around, but definitely we want them to have some traction. What is the product? How they find out their niche, their go-to-market strategy, and how they're going to scale from there. So those are the elements. Well, our secret sauce is we understand the community, We understand the Latinx community. We are very diverse. It's not just one group of Latinx entrepreneurs you're looking for. We have entrepreneurs from the Patagonia all the way to Mexico. And so that brings a lot of cultures and nuances. Having that many folks involved already provide us that cultural perspective to understand why they do things the way they do it and how they're approaching the market and what lens they're bringing into.
Thank you, Juan. Ben, so how about for you guys? How do you start that discussion and connect with people? And also one other question I'll throw in there is, do you communicate with other funds like Himalaya and Juan and talk to each other?
Well, we can start there. Communication between funds is probably one of the best ways to get warm introductions. And that's one of the things that we certainly try to do for all the companies that we talk to, even if we're not investing, is find the right path for them to go forward. And that often means making introductions to other investors that we know might be more aligned with what they're working on in the stage that they're at. But in terms of how we find deals, we have a lot of different sources. Most of it is a referral network. So, whether it's Juan or Himalaya or some of the other funds that we've engaged with, we have a lot of LPs. We actually have over 100 investors in Fund 2. So that provides us a great funnel or great pipeline for new opportunities. And then we also have cold inbound on our website. We get applications. We probably review about 15 to 20 new opportunities a week. It certainly helps when those opportunities are ones we've already heard of. And so that makes that review process a little bit easier for us. But there are always those diamonds in the rough that we haven't heard of, that no one else has heard of, and they just happen to show up. I actually got a cold email from someone, it's been 2 months now. And normally I don't respond to cold emails, but what he put in there, which was not much, but was so compelling that I had to respond to him. And looks like we're probably going to move forward with an investment. We'll see. We're wrapping up our diligence now, but it certainly looks very promising. So there are many ways to get in contact. But I think that the best is to just start doing the research of which funds and which investors are best aligned for what you as an entrepreneur and you as a company are trying to do, and focus first on those. And so even if you don't connect with the first one you talk to, they might open doors for the next one, and so on. And that's doing that research as opposed to a shotgun approach is usually what I found to be the most successful. And that's certainly what we appreciate.
Thanks, Ben. Himalaya, do you want to add a little more on this sort of connecting and?
Absolutely. So, Juan and Ben mentioned that referral networks are certainly a great way to get warm introductions to companies. And that is something that we also strive to do, is to be able to connect a lot of the companies that come to pitch us with other angel groups if they're a little bit too early for us, or other funds if that seems like it's better alignment. One thing I will say that is a little bit unique is that we have tried to create less of a barrier to reaching us as a fund. So I know that oftentimes, because all of us as funds are talking with one another, we get warm introductions. And so then there's this massive portion of companies that are left aside because they don't have any referrals to be able to get into pitching with funds. And so something we've done with Black Founders Matter is, if you go on our website, it's actually pretty detailed about our eligibility and our criteria and our screening process, and also gives an understanding of the different types of money that you can get as a startup, and for you to self-select and determine if Black Founders Matter is the right venture fund for you. And then there's an application process. And actually we have hired on an associate, and we also do it ourselves. And we go through every single application that comes through, which is significant. And we make sure that every single person that applies, that self-selects after they've gone through the different funnels and ensuring that this is the right fit. We actually talk with every single one of our cold outreaches.
Thank you, Himalaya. Well, why don't we reverse the order? So I'm going to let you take this one first. Let's talk a little bit about the timeline and the process, who's involved, what it looks like, just so these entrepreneurs can have an idea that once they've contacted you, they've met you, how long does it normally take, and what will due diligence look like? Ben mentioned that investment maybe in a couple months. Is that the normal experience, or is it something different that you have? So,
Yeah, absolutely. So with any venture fund that's professionally managed, it's not, well, not any, but most of the venture funds that are professionally managed won't have an LP base to be able to have that vote. It will be just the professional managers. So they are able to move a little bit quicker. And so that is the case with Black Founders Matter. I will say with the professionally managed fund and our screening process, it also depends on two things. One is the timeline that the founder is at. And so if they are 2/3 of the way, and this is something I talk about a lot in the screening meetings, if you're 2/3 away through the funding round and you only need that little bit of time, it will collapse the time frame that investors can get into your round. And so you hold the most leverage. Whereas if you're right in the beginning, and you're socializing your deal, the terms haven't been set because you don't have a lead, it often takes a longer time, not necessarily for the due diligence process, but for us to be able to help you secure a lead, to be able to solidify those deal terms. So what we've seen on average, it can go from anywhere from 2.5 weeks to 2 months. And mostly that's surrounding if we are able to help secure that lead to move the investment forward.
Thank you, Himalaya. Ben, how about timeline for you? You did touch on it, but I'll let you respond some more on that.
This is always such a tricky question for me, and I actually had this conversation with an entrepreneur earlier this week. I would love to be able to say things move quickly, but they don't. And it's, you know, some of that's in our control and some of that's outside of our control. I think that there's a lot that happens behind the scenes with managing a fund that entrepreneurs don't see, because it's like, well, you have money, you just write the check, and that's what happens. But there's a lot that goes into diligence. There's a lot that goes into the legal paperwork just to make sure that everybody's happy on both sides. And so the more parties you're engaging, the longer things take, because now you're managing a lot of different schedules. And so I think just being aware of that and having that patience will set you up for success. Coming prepared, like what Himalaya was talking about too, especially having all of the documentation ready to go right away if someone wants to go to diligence, will do so much to decrease the amount of time and increase the pace with which someone makes a decision. So often we see entrepreneurs start with a data room and then we have to request some documents, which means they have to then create them, which is another few days. And so it's often a back and forth, and that just lengthens the time. And so the more you can come prepared at the outset, the faster that decision will be. That being said, for us, typically we're looking at, ideally we're targeting 2 months from first meeting to having, if we make an investment, to actually making that investment. But it can be, as Himalaya said, much shorter if we're really excited about a deal and we feel the need to move quickly. But often it's more in 2 to 3 months is about how long it takes. And that's because we're also doing this in the context of everything else that we have to do, managing the fund, investor relations, all the administrative work that goes into it. So it's not that we just sit there every day, meet with entrepreneurs, and then write checks.
Thanks, Ben. Juan, how about timeline for your fund and how you approach it?
Yeah, so we meet every Monday. For us, as all the scouts and the fund managers will be every Monday. We go over deal flow and the startups that we're excited about it. We present to the funding managers, and once the group agrees that there's an entrepreneur they want to look forward into it, we pair up. We meet right away with them within a week timeline. That we contact them. We ask more questions, and just to what Himalaya and Ben mentioned, it's already existing investors on they bring already, and they're either in a seed round that moves faster, but we think we can move as fast a couple of weeks if they're about to close the round, and there's a little bit of room that needs to be completed to get the deal done. But we try to get everything done within a month from contacting you, letting you know that we're interested, and asking the additional questions for due diligence to finally closing.
If you don't mind, so one of the questions that came up, and I know Himalaya, you're talking, about leading the deal. So one of the questions, and everybody can respond to this, but what factors determine what fund leads the deal? So I was wondering, just before we move on to the next question, if we could address that real quick.
Sure. I mean, I can start that, and Ben, I'm sure since you lead rounds, you can talk more about that. Just in terms of like the basic financials, a lead would be expected to not just put in a minority stake of that, but to be able to put in a sizable amount. But beyond just the financial portions of it, the lead is the person who, or the fund, who is going to be able to help solidify the terms. And so that's like your valuation cap, maybe your interest, your discount, but then also if you're further along, some of the control rights. And so all of that negotiation, lead firms need to have the capacity. And as Ben is mentioning, it's not just about evaluating if it's a good deal or not. Once the decision is made to invest in it, if they're a lead firm, there's a whole back and forth in negotiation around the term sheet. And getting through all of those different clauses takes like some time and legal capacity. And so not all firms have the ability to do that. And that's why at a $10 million seed stage fund, we've chosen the follow positions, and we make strategic partnerships with lead firms. Ben, I'm sure you have more things to say on that.
I mean, that's a big part of deciding whether or not to lead. I think a lot of it has to do with strategy as well. How good a strategic fit is the company with the fund, with the portfolio? What additional resources can the lead investor bring to actually enhance the overall investment? I mean, every investor should be strategic in some way, but often the lead has a lot of strategic value, and that strategic value can be today and it can be tomorrow. And so I think when you're talking to different investors and considering, if you have the opportunity to consider multiple leads, who is it that is going to provide that value? The lead doesn't have to be the biggest investor. I think that's also important. Sometimes it's just assumed that the lead has to be the one writing the biggest check. Usually, yeah, but not necessarily. But no, I don't want to belabor or be redundant. So I think, Himalaya, you covered much of it very well.
Juan, does your fund lead, and do you ever get involved in that sort of making decisions about who's going to lead?
We do. To be fair, I mean, I think Himalaya put it very well, and Ben that covered most of the items, and the fund can take the lead and around, and it's pretty much all of this along the same lines as described by Ben and Himalaya.
So once they've, a company has contacted you, you have shown some interest. What kinds of things that will the company need? What kind of materials? And maybe even if we want to carry that on into due diligence, what are you going to be asking them for? So just so they have a better understanding of what they're going to need to start preparing. Let's start. We'll go back to you, Juan, and then work our way back around. How's that?
I didn't hear the question. Could you repeat it again, please? Sorry.
Yeah, so I was saying, so once a company has contacted you, what sort of materials will they need to pitch? And then also, what sort of documentation are you going to be looking for in terms of due diligence, just so that our audience has a better understanding of what they're going to need to prepare?
First, just keep it casual, very simple. What is your business plan, right? What is your go-to-market strategy? What is your traction? And if we decide to move forward, we're going to take a deeper look at the financials, right? What are your sales? What is the traction you bring in? Who, if you have already existing investors, question your cap table, just to get started from there. As the things get more complex, definitely we'll take a more closer look at your existing contracts, especially for the direct to consumer or consumer packaged goods. What kind of supply chain, co-packers, contracts you have, just to make sure that everybody is considered on in our numbers and our assumptions to help us make the decision who needs to be involved in the deal, right? Many times we see teams that in order to get the funding, they have taken loans or they have taken friends and family funding, and it is not clear who owns at what part of the company. So just keep it clean. I'm happy to talk offline. What are the pitfalls that we see? Probably Ben and Himalaya have more horror stories to talk about, the things that could go well and didn't move forward because something stopped the deal, right?
Thank you, Juan. Ben, how about, have any different approach to due diligence or the types of things you like to see, or even if you've got some interesting thoughts about, experiences you've had in that regard?
I'm going to defer the horror story answer for a while. I think it depends a lot on where you are as a company. How mature you are will determine what kind of documentation you need and what investors are expecting. But I think at a bare minimum, one's exactly right: finances, and just a general overview of the company. But some of the big things that we look for are kind of all the necessary legal paperwork. We want to see articles of incorporation. We want to see founder agreements. We want to see restricted stock agreements. We also want to see any kind of outstanding contractor agreements, whether that's with the founders or with related companies. We just want to understand what's been done so far and what liabilities exist. Make sure things are buttoned up. We don't want to jump into a company if we feel like there are some questions about where money is going to be going and if there's the potential for double dipping. When it comes to finances, it's really easy to create really complex financial models that don't help people. They might help you as the founder or as the financial person because you're so deep in the weeds in it. But when you want to convey a story, when you want to tell someone exactly how you're going to grow, have that complex model, but also have the very simple quarterly or annual projections. Have both of them so that as we get farther and farther into diligence, it's easier for us to then do our own testing rather than constantly be asking questions. I'll use the same company as an example, the one that did the cold outreach. We're in diligence right now. He gave me access to their live KPIs. So I can see on a daily basis how things are changing for them because they've got users. I can see their engagement numbers. I can see their signups. That's fantastic. And it makes it really easy for me to make an assessment of whether or not I think the company is going to continue to grow. If you have IP, have that ready. You don't necessarily need to show the final patent, but if you're licensing technology, have the license agreements available. If you have a patent application, have the patent application available. The less searching that we have to do, the faster we'll be able to get to a decision, and the more confident we will be that you as a team and you as a company have everything ready to continue to grow and scale.
Thank you, Ben. Himalaya, any further thoughts on due diligence and kind of things you're looking for?
Sure. I mean, I think Juan and Ben covered a lot of the documents beyond the formation documents, also things related to the regulatory concerns and related to customers. One thing I will say is we get a lot of pro formas, which is your financial projections, not your actual financials. We get a lot of pro formas that are from an operator's perspective. And so it's looking at like all of the breakdowns of the different like SKUs and like model numbers. We don't necessarily need that. We do need a different level of financial analysis. So when you're thinking about it, a good way to think about it is you have your financial projections. Maybe you aim to make $20 million this year. How many customers will validate those $20 million? How many units need to be sold in order to get to that $20 million? On average, how many units is one specific customer ordering, right? And so you can look at it from that perspective and make sure that the pro forma is indicating the number of customers that need to validate the financial models, and on average, what is the average and range of the customer order? So that way we can understand the contract value.
Thank you. So is it helpful that then when they're doing those pro forma financials for them to have, like, for example, all their assumptions pretty clear for you to see what those assumptions are with it, they're...
Yeah, absolutely. I think that oftentimes people get really caught up on the numbers, and I don't know if Juan and Ben would agree with me, but we never consider the actual numbers to be correct. But what's more important when looking at the pro forma is understanding the underlying assumptions so that we can understand how you think of your business and how you think you're going to validate those models, and whether that's like on a B2B versus a B2C, whether it's like a high growth strategy with just a small number of companies land and expand, or if it's this constant churn and like large volume. And so it's more of like the methodology that the financials present rather than the numbers itself. So to your point, Ernie, definitely be super clear on all of those assumptions. And if you focus really heavily on the number of customers, the types of customers, and their contract value, that can start to suss out a lot of underlying assumptions without us having to go back and forth and ask those questions.
Well, just looking at the time, we're about almost 40 minutes into this. I thought maybe now, why don't we take a few minutes? I think each of you have thought about maybe some horror stories or just an example story of an investment, either all the way you finished the investment or it failed. So whoever wants to go first, I'll let you reach out. But if you've got a story, why don't you tell us now?
I can actually take this and go first. I will, because I think that we might veer into the horror story. I will start off with a positive story of a company. So one of the companies that Portland Seed Fund invested in that I actually led in a different fund as well is called Alley-Oop, which is a makeup company. And as we all know, the cosmetic and makeup industry is very saturated. And so you would think like they're already, you know, like they have a lot going against them to get investment. And what I wanted to share is how they were able to overcome those barriers to actually get investment. And the way that they did it is that they were very, very focused. They weren't competing. I mean, the natural question is, how do you compete with Maybelline or Revlon? And the answer is you don't. You don't try and position yourself against those big conglomerates. Instead, you get to know your specific customers extremely well. And through your pitch and your pitch deck, you articulate exactly who your customers are, your specific subset of customers, how their conversion patterns are, what their consumption patterns are, what other types of things they like to purchase, and being able to understand what that customer acquisition, retention, and engagement strategy looks like for your particular customer. Something that they were also able to do then is talk about their features, relating it back to the customer. They said, we don't have all the features. When sometimes you look at those graphs, there's like 12 features and only you have it and no one else has it. It seems like kind of skewed, right? And what they were able to show is there's any number of features, but we don't focus on all the features. We focus on these 4 features because that's exactly what our particular customer is looking for. And so every single slide throughout the deck, they were able to weave in how, like, specifically they knew their customers. And so then when we talked about that in comparison to a crowded marketplace, we were able to very quickly see that they're not competing with a large conglomerate. They are very actively focused on a hyper segment of their customer base, and they know exactly how to convert them, how to engage them, and how to retain them. So I would say that's what made them stand apart. And that's just a piece of advice for anyone. I know it has a tendency to boil the ocean when you think your product can serve and touch every single type of customer. Focus on one customer, focus on how to acquire them, focus on how to engage them, and how to retain them.
Thank you, Himalaya. Juan or Ben, do you want to go next?
I have a good horror story segue from that, actually, which is an investment that we made out of Fund One that when we did the diligence, everything looked good. And unfortunately, the focus on the customer was the focus on the wrong customer. And there were 3 potential customers in the market, three potential customer types in the market. And the CEO was the one we were betting on, who had experience working with the customer that he was targeting. And so our expectation was through that experience, he would be able to then sell back to those customers. That turned out not to be the case, but we didn't find that out until about 5 months into our investment, when the company was almost out of money. And we didn't know about that because of a lack of communication. And by the time they pivoted to start trying to sell to different customers, they didn't have enough runway left to do that. So really, I just want to reiterate Himalaya's point, really truly understanding your customer and understanding the purchasing power, but also the decision-making by the buyers within those customers is incredibly important, both obviously for us as investors, but also for the success of the company long-term.
Thank you, Ben. Juan, would you like to add some thoughts?
Yeah, when you're an entrepreneur, and I have been in that side of the table, right? You're excited about your product, you have some traction, you finally got that purchase order, and it is difficult sometimes to find the capital if you're not in the software tech area. So that capital intensive approach where you need to buy inventory is difficult to find. And 2 things, just make sure that you get professional advice, you get an attorney. If you're gonna look for investment capital for an investor, seed round, angel investor, VC, make sure you have an attorney that's able to set up your entity and able to guide you and advise you to the pitfalls of many founders. Sometimes you are so eager to get into a deal and somebody offers you $10,000, $20,000 for X amount of equity. And in some instances, those deals can be onerous and not very founder friendly. So it's good to have somebody in your corner. People like Ernie and other folks in Portland will sit with you and give you that initial advice just to how to protect yourself. One, and the second piece is just keep your numbers in check. Who you're taking money from, what kind of deals you are making to get that first product out of the door. Keep it very organized, very clean, because if it's not, it will come back to haunt you and slow down any deal or derail potentially any investment that you have, right? So those are two things. Get assistance from the professionals. Might be a little bit scary because it might seem expensive, but a lot of people in town are willing to help. And second, just keep your numbers clean. Doesn't have to be super complicated, but just keep it clean. That way it's easy to sort out when you're ready to move on and scale.
I'm gonna hop in real quick because just wanted to let folks know Himalaya is in high demand and double booked today is what I was gonna say. And so again, at the end, I will share my email address again. So if you have specific questions for Himalaya, just send a note to me and I'd be happy to pass it along. But I just wanted to thank you, Himalaya, for at least giving us these 45 minutes. I really appreciate it. I think the entire audience really appreciated it. It was great to have you be part of the panel. Juan and Ben are going to stay online until 1. So with that, thank you again, and we'll see you soon.
Yes, thank you so much, Laura, and thank you, Ernie, for having me here. Juan and Ben, it was a pleasure to see you again. In the chat, I've put my 2 emails, Himalaya@portlandseedfund.com and Himalaya@blackfoundersmatter.org. So feel free to contact me as well if you have any other questions. But thank you all so much.
All right, take care now. Bye.
Thank you, Himalaya.
One question I was going to pick up, Himalaya mentioned it about this, being hyper specific customer, and how important it is as you work with entrepreneurs for them to really know their customers. I think the question is around, if I think concern some of the entrepreneurs have, and Himalaya was saying like boiling the ocean, we understand that, but I think the question was, if I narrow the market, is it too narrow and is it big enough to attract investors from the funds? So I wonder, Juan and Ben, if you could comment on sometimes even market size or on that comment of how big does it need to be in order it to be of interest to the funds?
Go ahead.
There's a reason we talk about TAM versus initial customer.
Yeah.
And what's particularly important for me when I'm evaluating deal is I want to know how you see the opportunity growing, what you realistically think the potential customer base is overall. That's how we're thinking about TAM. But then who is it that's going to be the early adopter? How do they make purchasing decisions? What is the type of purchasing mechanism they want to do? Do they want it to be a subscription? Is this a one-time revenue source? Is this service versus a product? Understanding that at a granular level for that initial customer is the focus that we want to see, because you have to execute first for those customers before you can start to serve the larger opportunity. So we like to see big TAM, because that means that there is an opportunity for the company to grow. There is going to be the attraction for an acquirer to come in and potentially purchase this, but you can't get there if you're not making your first customers happy. So we want to know that you really understand your first customer before you can start to grow to the big customer.
And TAM is total available market, if people aren't familiar with the acronyms. I've worked in a lot of different industries, and it's always like alphabet soup, no matter where you work. So anyways, if people have questions on that, feel free to either put it in the chat or the question, or just give me a shout later. But thank you, Ben, appreciate that. Juan, any other comments just in terms of size of markets or anything else you'd like to add?
No, it's for example, we're talking about consumer packaged goods, right? I mean, what is the existing products that are in the market? As a company, Vamos just invested on the Mex cocktails. They have a special container where they make fresh juice is refrigerated, and the bottom of the container is the spirits, vodka, whiskey, whatever is your favorite cocktail that you want to mix with. And the way it's designed is that once you twist the bottom and the top parts of the container, it mixes your cocktail, and it has 2 cocktails to go, right? I mean, but they're marketing to these high-end bartenders that have a following, right? I mean, I didn't know about this, but in Los Angeles, Texas, New York, East Coast, they're very popular that these bartenders are able to market their own mix of cocktails and being able to take it to market and use these containers. So they have proven that month after month having a 10-20% growth. So it is the growth, and that is definitely driving the conversation. But how you addressing a market opportunity that is a niche, but it can evolve, right? It can evolve to no one-offs, but different market lines. To what Ben was alluding, right? Once you get your foot in the door with that market segment, what other products you can bring on it? And direct to consumer packaged goods is totally different, and many times it's the brand play. But once you have the brand cemented and people know there's good quality, that whatever they buy from you is going to be always working, tastes good, it smells good, and it lasts a long time and delivers the promise, you can grow from there. But you got to start with that product versus trying to go to multiple flavors, different fits, different textures. So
All right,
all that makes sense.
Yeah.
Can I add just a little bit to that,
Oh
Laura?
yeah, go ahead, Ben, go for it.
Because it's perfect timing, because I was just on a actually call with one of our portfolio companies this morning. That's a CPG company. And this goes back to Ernie's question of what should you have, or what ideally information will you have available for diligence that will speed that process and make investors more excited. So we just went through, this company brought in a marketing intern for a month, and she gave them so much incredibly valuable data simply by doing the research, all through publicly available sources, that will help them with their brand positioning. It will help them really identify what niche in the market they can target, so that then, talking about one, it's like, for the bartenders, this is specifically the kind of bartender, or this is specifically the area in the country that would be most amenable to adopting this particular product. It shows foresight, because it shows that you're thinking about who the potential competitors are. It shows that you've done your research to really understand where in the market you're going to be. And it shows how then you can start to expand, because now that you really know where you fit within the market with all these other players, you can start to identify the holes that they're not addressing. So I think prior to getting an investment, if you come prepared with that kind of information, you're going to look much more professional. And then whether or not you get investment, just in terms of the growth of the company, if you've done that work, you're setting yourself up for success, because now you have something to focus on as your core customer, and you can tell that story of, here's the customer that I'm serving today, here are the opportunities I have going forward.
Great, thank you so much. Another question that comes up frequently is in looking at the funding ladder. So oftentimes I'll talk with early stage entrepreneurs and say, you start with friends and family and then angels. And oftentimes it's hard to skip rungs in the ladder as you go up. So the question is from one of the folks in the audience. So Juan mentioned the friends and family round. And the question revolves around how is equity determined for those super early investors? So what part of the company do they get? And will the lead investor determine that? And if there are a lot of small investors early on, is that a deterrent and seen as complicating the cap table? So I wonder if you all could address that question.
Ben, you want to start the cap table? How not to keep it clean and not dirty?
I can start, sure.
All right.
At the end of the day, the cap table is your headache, not the investor's headache. So I think it really depends on how many investors you want to deal with. If you need the money, you need the money. And sometimes that means you're going to get 30 or 40 investors on your cap table before you raise a big round. We have a very well-known success story from Portland where the company had a lot of small investors initially before they ultimately were acquired. And that was fine. That never actually hindered them from getting more money and being successful. Determining equity for early investors, especially if you're talking about that very, very first money in, that's why convertible notes exist. That's why safes exist, is to help you bring money in, protect the company, but also give investors some incentive to come in when really you don't know much about the company or the success that the company's going to have, but your parents, your friends, your close family, your friends want to support you. And so they're just giving you some money to do that. So you can structure an investment vehicle so that you're not really determining what the equity ownership is. You're just ensuring that those early investors get a little bit of a bump in the value of their investment versus when someone comes in later. A lead investor might determine that, but that's only once you get to the equity rounds. You can be a lead investor on a convertible note, which ultimately does not determine equity ownership. So it's a little bit of a vague answer to your question, Brandy, but equity is a complicated conversation and it happens over time. But I think what I would say is, for the worry about having too many investors on the cap table, I think is something that takes too much brain space. If an investor comes in and really wants to invest in the company and decides they don't want to have all those other investors on there, they'll figure out a way to not have those investors on the cap table. If that means buying them out, if that means consolidating them, whatever it is. If you're attractive enough to a big investor, the number of investors on your cap table really doesn't matter. So I would not get hung up on that.
Normally, friends and family, they're giving the money to support you. They believe in you, and you will take care of them. As a founder, you're looking for a way to do right by them. But I circle back to my comment earlier, right? And many of us started a company as a LLC, and when we started looking for institutional funding, we converted to a C Corp. That's a perfect time to, what Ben alluded, structure your convertible notes, make sure that the folks are taken care of, but also it's a framework that will allow you to move forward, right? And we see the conversion from LLC to C Corp as a daunting process. It could be a lot more complicated once you are getting thousands of dollars in sales, or you have the perfect deal on the table that is hung up because you had to go and do a lot of cleanup in the back end. But at first, mom and dad, friends and family, they are doing it because they believe in you, and they will be flexible to a degree. And as a founder, you always want to take care of the folks that believe in you at the beginning.
I'll interject here for just a second, but I think, the one just simple point about all this is I think you do want to engage an attorney relatively early who is used to doing startups and the startup process and can help talk you through the note and safe option and what that's going to mean when you later try to raise money, and also help you maybe model what those notes will look like once they convert, because I think that's a piece of this that's sometimes not easily grasped by entrepreneurs if they don't really understand how those notes convert, what they mean in the cap table. So just having that conversation with your attorney early is helpful, I think, for Ben and for Juan.
Yeah, thanks for adding that, Ernie. We just got, looks like time for one more question, and so I'm going to pop in and ask it just because it was brought up again. But sometimes entrepreneurs are frustrated because they send a cold email to venture capitalists and they go, but Laura, I didn't hear back from them, right? And as you all are saying, you get inundated with people sending emails, so you can't respond to all of them, number one. But the question was around, what sort of messages or what things do you find that are compelling? Like if someone does send a cold email, I think, Ben, you might have mentioned that someone had sent you a cold email and they had some information in there that made it compelling for you to look a little bit further. And so, I mean, it's going to be unique, right, for each entrepreneur. But any thoughts that either one of you have just in terms of what would make you want to learn more?
Go first one.
Yes, is just make it compelling, straight to the point, right? What is the problem you're solving? You're gonna become the next. You bring in. I'm talking about an entrepreneur that I've been working with for a little bit. You're gonna bring a shortbread cookie made from Argentina, and you want to explain what is your competitive advantage, what is that you're doing, and in this case, this individual has already a purchase order for 60,000 units. Just trade for that. I'm bringing the alfajore from Argentina, gluten-free, manufactured here in Portland, and we just received 60,000, an order for 60,000 units. That by itself gets my attention. And then if you include a deck that to what Himalaya and Ben alluded earlier, that weaves the story why this is a market opportunity and you are pursuing it and believe on it, you have the conviction that this is going to go to market, then that will lead to a follow-up call like, okay, let's talk. Let's dig a bit deeper, right? You have a purchase order, you have a patent, and that would entice me to open the email and look at the deck and what you send along with that. I think those couple of things that will help out.
Mm-hmm.
At the end of the day, we'll get to you. Be patient. There's a lot of emails coming, a lot of intros, and we'll try to be transparent to get to you as soon as we can, within a reasonable time. And I know that you are eager to get an answer to that conversation.
Ben, anything else to add?
First thing I would say is I don't just receive cold emails. I receive cold contact on LinkedIn with, lengthy explanations and pitch decks there as well. So it's not just one source. So it's just understand that, as Juan said, there is a lot of inbound that we receive. If you are attaching a deck, don't use the body of the email to recreate your story. Get right to the point, just like what Juan was describing. The guy who emailed me that cold inbound that we're now in diligence with, basically it was a 2-line email that said something on the lines of, we have over 20 million users and I think it was like 2 or 3 million in revenue. Yeah, that's going to get my attention. Obviously not everybody's going to have that, which is okay. But the more storytelling you have to do in a cold email, the less likely it is to catch my attention.
Great.
So
Well,
have just hard numbers. It doesn't really matter what stage you're at, just have those hard numbers for wherever you are, and let the numbers do the talking and let the story be told in the deck and leave it.
excellent. Yeah, I think that's great advice. So we're at the top of the hour, so I need to close this up. But I just want to thank again Juan, Ben, Himalaya, and Ernie for this fabulous lunch and learn. I've been seeing notes in the chat room. Everyone's really appreciate all the information and advice. Again, this has been recorded, and what I can do is send everyone who's registered, I'll send you a link to that recording. Sometimes it's nice to hear it a second time around because you miss some of the nuances. And then if you have specific questions for any of the panelists or for myself, or Ernie for that matter, feel free to message me at Laura, Laura at venturecatalyst.biz, B-I-Z, and I'd be happy to pass your message along. And with that, thanks again, everybody. Thanks again to the great audience that participated in all the questions, and I hope everyone has a great weekend.
Thank you, Laura, and thank you, Ernie, for moderating.
Thank you.
Thank-
Have a great weekend, everybody.
Yeah,
Great
take
job.
care.
Take care.
Thank you, guys.